Welcome to Advisor Confidential, the podcast series that dives deep into the evolving world of registered investment advisors. Whether you're an established RIA, exploring the independent advisory space, or just curious about the future of fiduciary finance, this is your go-to source. We'll bring you expert insights, candid conversations, and real-world stories from the front lines of wealth management.
What is actual investing? We believe that it's our real-world task to deliver thoughtful capital deployment. It's not about speculating over the short term, it's about understanding the long-term opportunities for companies through technological progress or new business models. So we seek out those exploring big, new ideas that will change the world. Then we back them to give those ideas time to flourish. Baillie Gifford, Actual Investors. Find out more at baileygifford.com.
Welcome to Advisor Confidential, the podcast series. I'm Tracy Longo, Washington editor at Financial Advisor magazine. Today's episode, A Look at Investing in 2050, is brought to you by Baillie Gifford. I want to welcome our esteemed guest, Andrew Keiller, Baillie Gifford partner and investment specialist on the firm's emerging markets team. Today, we'll explore what investing may look like 25 years from now, focusing on the macro shift toward ex-U.S. markets and emerging markets, and highlighting how advisors and investors can capitalize on these rich opportunities. In this episode, Andrew will discuss how some of the fastest growing developing economies are driving global change and the forces that could accelerate these trends. The discussion builds on his recent paper, Emerging Markets in 2050, Growth in a Changing World. In it, Andrew identifies long-term structural shifts, tilting the odds in favor of standout companies, especially in Asia and Latin America. With global stocks continuing to surge and grab headlines, let's dive right in. Andrew, it's your first time here on Advisor Confidential, and we're delighted to have you. Can you introduce yourself, please, by sharing your background and how you came to focus on emerging markets?
Thanks very much, Tracy. Yeah, sure. I guess I'm rare in financial services in that I've only ever worked in one place since finishing my studies. I joined Baillie Gifford about 14 years ago now, and I've spent all but 3 years of my career focused on emerging markets. The reason I came to work on this asset class was, I would say, a combination of being in the right place at the right time and then following an interest from there. I was asked to conduct a graduate project very early in my career, which was about understanding how Asian investors were making use of overseas investment funds. And that led me to start working with clients in Asia. And from there, my interest in Asia grew. I wanted to learn more about how Asian companies and growth models work. And before long, I'd plotted my way into our emerging markets client team. So my day job now is focused on EM and managing relationships with our EM equity clients across the world. And I feel genuinely very lucky to work on such an interesting set of markets.
That's fascinating. With all the growing interest in emerging markets right now, we're delighted you joined us. The genesis of much of our discussion here today is your intriguing paper, Emerging Markets in 2050, Growth in a Changing World. What prompted you to look out 25 years for investment opportunities?
Yeah. Being honest, it was partly an unashamedly deliberate desire to do something different from everyone else. I got a bit fed up of reading commentary that makes out to be an EM outlook, but then it simply talks about where EM countries' GDP will be in the next year, or where EM companies are missing or beating their recent guidance. And I don't think that advances us much, or really is important to what is for most savers hopefully a long-term investment, and that's what should matter. So in that vein, I was reading about some of the longer-term structural shifts that impact emerging markets, like the shape of the global population in the future. So of the 195 countries in the world, about a third of the population globally is forecast to live in just 2 of those countries by 2050. And that's, of course, China and India. And when I first came across that, I started thinking tangentially on what that really means for how the world works. Will we still live in a world where the most influential products, platforms, and cultural norms are coming from the West, or will they be coming from Asian countries? And then what about global trade? What does it mean for the shape of the power in the world? 2050 is obviously so far out that even any hints of precision in this type of forward thinking would be silly. Things will change a huge amount, whether that's demographics, robotics, currencies, and so on. We went from clunky dial-up internet in 2000 to AI assistants in our pockets in 2025. The same span ahead takes us to 2050. And there's a decent chance that by then, EM countries will be the ones that are leading global brand ranks, leading global innovation. And we've already seen hints of this when we look at things like Korean pop culture going from niche to mainstream very quickly, when we see TikTok exploding from China to everywhere else in the world. Already there are very clear signs that emerging markets aren't just about catching up. This is about setting the pace. And that, for me, that's what's most exciting from an investment point of view.
Well, I think that long-term lens really resonates with advisors and investors focused on global, durable growth stories. As someone who looks for standout companies daily, what do you think is important about the macro shift to ex-U.S. markets, especially emerging markets, and how can investors benefit?
I think the macro is important. I actually think the micro is much more important. But on the macro, since you asked, what we can say is that most EM countries have been relatively orthodox since the pandemic. So many emerging market countries have been quite quietly getting their houses in order. By that, I mean fiscal and monetary policy has been conservative, and in many cases, often high profile cases, in emerging markets have been much more stable than we've seen in many developed markets. What matters much more for investors, I think, especially in equity markets, is that we've had a meaningful upgrade in the quality of companies. So the largest EM companies of the current age are tech hardware businesses and platforms. It's not uncommon to find growth rates of 30% plus in dollar terms here. And there are many more examples of this type of company than we've had in emerging markets in the past. But what's more important than results already delivered for these companies is that they're investing for the future as well. So many of the EM companies that we're investing in for clients today are very proactive in laying the foundations for the future. They're spending more and more on productive R&D, on high-tech capex. It's very well reported that the US majors are doing this, but EM companies are as well. You take the semiconductor sector, take the Chinese internet majors as a couple of examples of that. Now, EM's clearly done well in the near term, but it's also worth remembering how under-owned this asset class still is. So about 3/4 of global funds are underweight emerging markets today. And to me, that means there's got to be a big flow opportunity here as well. If you look at the total global equity market capitalization, it's roughly $120 trillion. And emerging markets accounts for $12 trillion of that, roughly, if you say it's 10%. Developed markets makes up the remaining 90%. Now imagine what happens if global investors collectively decide to increase their EM allocation by just 1 percentage point. That's $1.1 trillion flowing into this asset class. And for context, that's the size of the Mexican market and the Indonesian market put together. So the capital flow opportunity alone is big if sentiment shifts and keeps shifting in the way that it has been more recently.
Wow, that flow opportunity is intriguing. One of the trends, and you've touched on it already, but you've really focused on future Asian dominance, especially driven by sheer population growth. How do you think that will continue to influence and really impact investing over the next quarter century?
Yeah, I think population growth might be important, but alone it's probably not the key point. It's about improving productivity at the same time. And then when you combine that with scale, that's when things start to get more interesting. Asia's already home to well over half of the world's population and rising. It accounts for over half of global GDP growth. About 80% of the world's new middle class is coming from Asia every year. And it's rapidly becoming the global center for consumer spending. Now, one of the challenges that we used to have was that aspirational brands were all Western. And that, in some ways, put a ceiling on the upside for Asian companies. Once people in Asia got rich enough, what they did was they switched to foreign brands, and the benefits of that shift accrued out with emerging markets. But that is changing. If you speak to Gen Z in China now, it's the domestic brands they're more interested in, and that's what's that it's those brands that are taking market share. Be that in sportswear, be that in collectibles, in cars, in phones. And there's also a macro point to consider on top of this, which is, if we're talking about Asian growth, in recent years, we've been through the most aggressive cycle of Fed tightening in a generation, and Asian growth hasn't really skipped a beat. So on nearly every metric, whether it's debt levels, whether it's inflation, whether it's external surpluses, there's far greater resilience now than there ever has been. And it feels like that's still underappreciated, and the data would certainly suggest that's the case as well.
That's such a powerful reminder of how demographics really drive demand and investment opportunities. What are some of the other trends you think advisors and investors should be thinking about when it comes to investing with a 25-year time horizon in mind?
As I said earlier, I think any hints of precision on such a timescale would be foolish. I do think we should bear in mind that the model for emerging market growth is changing. So it's not just about exporting to the West anymore. That used to be the way to grow, but the model isn't the same as it used to be. And if I just look at the numbers, in the year 2000, there were about a billion people in the Western world and 5 billion in the rest of the world. By 2050, it will be just over a billion in the West and about 8.5 billion in the rest of the world. So the growth model changes, but that shouldn't be a surprise based on changes in global population. And within that, obviously, the harsh truth for us in North America and in Europe is that we need to understand we're becoming less significant, not more significant. By 2050, 6 of the 7 largest countries in the world by population will be countries that we currently know as emerging markets. So that's China, India, Indonesia, Pakistan, Nigeria, and Ethiopia. And for me, if that's the case, it means that global trade and global growth will have to change. I think there will be many more spheres of influence in the world. And the growth model for EM countries is not just about exporting to the West anymore. It's as much about these countries trading with each other. And look, we're already seeing big examples of this. We're seeing Chinese loans funding bullet trains in Indonesia. We're seeing Korean companies manufacturing in Vietnam with components that they got from Thailand. Recently, we've seen BHP, the mining company, making deals with China to settle iron ore in RMB. There's a growing list of EM to EM trade examples, and I think of all the trends that we'll talk about today, that's perhaps the one that is worth keeping the closest eye on.
That's great perspective, Andrew, especially for advisors helping clients think generationally rather than just quarterly. Instead of chasing short-term returns, I know you and Baillie Gifford focus on developing active strategies to help advisors and investors pivot internationally. How does active management help capture emerging market and international opportunities?
I like your phrase of thinking generationally and not quarterly. I'll perhaps steal that for the future, Tracy, if you don't mind.
Okay.
I
Be
think
my guest.
so. In terms of the reason for active management helping here, emerging markets is typically known as a set of markets where inefficiencies are rife and where there are good opportunities for active management. All I'd say here is that these inefficiencies aren't getting any lesser. So average holding periods are well below a year in these markets, and they're becoming more short term. Sell side analysts aren't getting any better at making forecasts for the extreme outcomes. And it's probably not the right time to go into that, but I've got lots of evidence to back that up. I'm not just saying that as a sweeping statement or a sweeping generalization. It's also worth saying that there's plenty in the index that doesn't look well set to grow into the future. Remember, the index is a reflection of past success, not future success. So I don't think it's the right starting point for building an EM portfolio. I think active management is the right approach for EM as long as you have a clear idea of the inefficiencies you can exploit for your clients and as long as you are structurally set up to do that. So you incentivize long-term behaviors if you're trying to exploit the short-term inefficiency in the market, for example.
Okay, it's really interesting to hear how active management can uncover opportunities that broad indexes often miss. So tell us, Andrew, about some of the emerging markets companies you've added that you think have the ability to outperform over the long term.
Yeah, there's so much we could go into here. I'll probably not talk about AI hardware as because there's thousands of others doing that already. Let's maybe start with raw materials. You know, I think we're going to need to get better at mining and refining key metals and minerals for our energy future. If you take something like cobalt, lithium, nickel, copper, these are all vital to the future. In each of these cases, a small group of emerging market countries control over half of the supply. And we see demand rising considerably in all cases, and not enough is being invested into new supply to keep this up. So all of that leads to higher prices. And if you've got any questions around the demand here, look at things like the rapid grid expansion to electrify rural areas and to connect renewables. A single kilometre of high voltage transmission line can use up to 2 tons of copper. So there should be an opportunity for EM countries and companies here because they'll be the supplier not just of choice, but eventually the supplier of necessity for huge parts of global industry. And that should put EM at the heart of the global industrial ecosystem in the coming decades. So there's lots to look for in raw materials. If we take a different example, we're also seeing many EM businesses that are still capitalizing on the fact that most of the people in their target markets don't yet have reliable internet access. And the emphasis on the word reliable there. Most of the people in the world who don't yet have reliable internet access are in emerging markets. For me and you know, a reliable internet connection is pretty much table stakes now for almost anything we want to get done. But for many parts of the developing world, it's really very different. But this will change, and we're seeing, you know, Google and Meta doing great work laying deep sea cabling around Africa. We're seeing SpaceX working to democratize internet access in places like Africa as well. So as reliability and connectivity improves, we see much better access to services for EM customers. And that's banking services, it's e-commerce, it's healthcare, it's education. And the real opportunity for companies is that legacy infrastructure and legacy behaviors doesn't need to get in the way here. So the concept of leapfrogging is not new, but it's very important. If you look at digital first banking in Latin America, it's a very good example at the moment. So banks without branch networks are the ones that are setting the pace. They're offering traditional credit, savings, insurance, but they're also offering sophisticated peer-to-peer services, crypto, a huge amount more entirely digitally to people who don't even know what a bank branch is. And they're doing so at a fraction of the cost of the incumbent banks that they are trying to leave behind. And so you know, this access to the internet and access to reliable connectivity is providing lots of opportunities across different end markets for EM investors.
Those are terrific examples of how innovation, scale, and need are translating into real growth stories. One notable theme you discuss in your paper, and you've mentioned here a little earlier, is that back in 2000, only a quarter of exports from emerging markets were sold to other emerging markets. The rest were absorbed by the U.S., Japan, Western Europe, and other advanced economies. Today, half of all exports are sold from one emerging market to another. Do you think the trend will continue, and what are the investing implications of this significant shift?
Yeah, you're right, Tracy, that there's a real observation, and it's backed up by trade data that more and more exports from EM are going to other emerging markets, and it's almost half of all exports now. There are lots of implications of that potential shift. One is about who you design your products and services for, because if you're designing for the West, you design for a very different set of preferences than you do if you design for an emerging market neighbor. If you look at BYD in electric vehicles, they've been hugely successful in China, but their export success has been to the likes of Brazil and Thailand, and a lot of it's been because they have redesigned things for these markets. So whether it's designing for a different set of charging infrastructure where the grid is patchy, or whether it's designing different battery specs for a hotter climate, I think the idea of designing for your EM neighbors will become more important if this trend continues. Another implication might be on currency, and less trade might need the US dollar. Let me be clear, I'm not talking about the dollar disappearing by any means. I'm talking about the end of exclusivity. We're already seeing some commodity trade settled in rupees or RMB, for example. You've got major economies trading together and saying, we can do this ourselves now. We don't need the middleman anymore. And if trade is increasingly settled in local currencies between these markets, then the capital gets recycled locally as well. And that's where the positive feedback loop starts. And so we might just be seeing that emerging markets are gradually building the financial autonomy that they need to withstand shocks. Because historically, that's not been the case. When EM countries have got big swathes of dollar debt and they're very exposed to dollar trade, then they've been punished by US monetary policy that frankly they had no part in setting in the first place. So if that begins to change, then suddenly they are more dependable, they're more stable, they're potentially less volatile, and who knows, we could see them command structurally higher valuations as a result of all of this. So that's just a couple of potential implications. That there are many more as well.
These shifts really underscore how interconnected emerging economies have become and what that means for diversification for advisors and investors. Another of your themes is digital first companies, those that use the internet to reach underserved communities. You have quite a few of these in your portfolios. Can you give us a few examples, please?
Yeah, I mean the digital banking example from Latin America from before is one of these. There are many others. The obvious place to go here would be China and the platform companies. We've got the likes of PDD, Kuaishou, Little Red Note, many others that are reaching well beyond tier one and two cities. A lesser known example comes from Kazakhstan. And if you live in Kazakhstan today, chances are you use an app called Kaspi every single day. This is one of our investments. It's a mobile app with over 14 million monthly active users, which is a staggering number for this country, considering the population is only 19 million. So we're talking near total penetration amongst the adult population. And Kaspi is an app that encompasses a very wide range of services. You use it to pay your rent, to pay your gas bill, to buy groceries, to take out a loan. In some places, even school fees and taxes are paid through Kaspi. Many places don't even accept cash or card anymore. They're just taking Kaspi QR payments. And when you ask people what they're using the app for, the answer is often, well, I use it for everything. It's growing further into other services still, and it's got ambitions in neighboring countries as well. A couple of my colleagues saw them on site last year, and they met a lot of customers and merchants too, and they came back very positive. So just one example, that there are lots of examples of companies that are using the internet to reach underserved communities, and this is an important trend for our portfolios at the moment.
Digital first models are clearly reshaping access to financial and consumer markets in ways few could have predicted, but that you and BG are really honed in on. On the topic of China, Baillie Gifford's emerging markets team has a number of stocks in its portfolio. What do you like right now, and what do you think a trade clash that's been ongoing between China and the US could disrupt in terms of your China holdings?
Yeah, look, I think a trade clash could be disruptive. I am very conscious we're recording this very close to the time that there's the summit taking place in South Korea, so I'm not going to be too definitive here. I think you need to be very selective here. So some companies in China are very export dependent, others are not. Those that are export dependent, some of the very large ones do have enough financial firepower to cope with policy change, and many have already been setting up production elsewhere to help them cope. Most of the Chinese companies we look at, for what it's worth, are primarily domestic in nature, and most of the revenues for the Chinese local market are coming from China itself. So I do think we need to maintain perspective. And as far as the here and now is concerned, I don't actually think tariffs matter too much to China's long-term destiny at all. If you look at the importance of China's exports to the US as a portion of its GDP, it's about 3%. There's a huge amount of focus on this topic in headlines. I don't think there's enough focus on the domestic opportunities. If I look at China's own retail sales, for example, they are over 10 times the size of its US exports. The other thing I'd say here is that we should pay attention to what domestic investors are doing, and any shifts towards the stock market could be very impactful. If I look at the numbers on this, so China's stock market value is approximately $17 trillion, but the amount in bank deposits is $22 trillion. Banks aren't paying very much in terms of interest. Yields in the fixed income market are very low, so the equity market might become a more attractive savings vehicle for Chinese investors if policy is designed such that it makes it even more attractive still. And just to give some comparison on that, in the US, the equity market value is about $70 trillion, but bank deposits are $10 trillion. So it's the other way on, and by some margin. So I think we should pay attention to that. That might present a big opportunity. Again, I was talking about the opportunity for flows alone earlier. This is another one of those.
It's impressive how these companies can build enormous scale right within their borders in China and other countries. Let's close with this. What do you think is the biggest risk when it comes to emerging market and ex-U.S. investing?
Yeah. Look, there's always risks, so let's not be flippant or dismissive about that. At the portfolio level, I'd always say the bigger risk is not actually making a poor investment. It's about missing out on something that goes really well, which can grow multifold. That's the nature of equity markets. I'm biased, of course, in this, but I think you're taking on a big risk if you're underexposed to these markets, to these type of companies and countries. These are the parts of the world where the future is being built in many ways. And hopefully some of this conversation has helped to highlight just how central the developing economies of today will be into our futures. These are not speculative stories. Most of them are profitable, they're scaling, and they're operating in markets with decades of growth ahead. So perhaps predictably, my answer to the biggest risk is not having enough of this.
That's a perfect note to end on, especially for advisors seeking to balance risk with opportunity in emerging markets. Thank you so much, Andrew, for joining Financial Advisor Magazine and Advisor Confidential, the podcast series sponsored by Baillie Gifford. And thank you for sharing such rich insights into how you and Baillie Gifford are approaching ex-U.S. and emerging market investing for the next 25 years. And to our audience, thank you for listening. Get in touch with us at Financial Advisor Magazine for more expert wealth management growth advice by visiting fa-mag.com. Don't forget to subscribe and click the follow button so you never miss an episode. We look forward to welcoming you back for the next episode of Advisor Confidential.
What is actual investing? We believe that it's a real-world task to deliver thoughtful capital deployment. It's not about speculating over the short term, it's about understanding the long-term opportunities for companies through technological progress or new business models. So we seek out those exploring big, new ideas that will change the world. Then we back them to give those ideas time to flourish. Baillie Gifford, Actual Investors. Find out more at bailliegifford.com.
Thank you for listening to Advisor Confidential, the podcast series, where we dive deep into the evolving world of registered investment advisors. From compliance to client experience, digital tools to succession planning, we cover what matters most to RIAs today. Learn more by subscribing to this podcast or visiting fa-mag.com.